So you're starting a business with a partner? It's an awesome feeling, right? You map out everything, the business model, the financials, the marketing strategy. You're building this amazing thing for success. Together, it's all about the upside. But have you planned for when things go terribly wrong?
Okay, so most folks, they do plan for a partner's death. It's grim, I know, but it's a necessary part of any solid business agreement. But get this. What if I told you there's a scenario that's actually worse for the business? A threat that could do way more damage, one that can absolutely cripple your company in a way that, believe it or not, a partner's death doesn't.
And that's the one, the sudden and permanent disability of a partner. Just think about that for a second. It's this awful state of limbo. The business is totally stuck. You've got a partner who can't contribute anymore, but they're still an owner, and you're feeling the crushing weight of their absence every single day.
All right, let's really unpack this, because this right here is the ultimate unseen threat to a business. We're not just talking about removing a key player from the board. No. This fundamentally changes the entire rulebook of the game, while that person is technically still in it. So what does this partner-down dilemma actually look like in the real world? What is all this chaos I'm talking about? Well, when a key partner goes down, it isn't just one problem. It sets off a crazy chain reaction that can seriously threaten the whole company.
The best way to picture it is like a seesaw, right? A healthy business partnership is all about balance. Each of you carries a specific weight, a certain part of the load. But when one partner is suddenly totally unable to carry their side, whoosh, the whole thing gets thrown completely out of whack, leaving the other partner scrambling to hold up their end and keep the other side from crashing to the ground.
And that's exactly when the dominoes start to fall. First, the healthy partner, they're instantly buried, shouldering twice the workload. At the same time, the disabled partner might still be legally entitled to their salary, so you've got cash draining out without any contribution coming in. Productivity just nosedives. But guess what doesn't stop? The bills. It doesn't take long to realize there's really only one way out. For the business to survive, you have to buy out the disabled partner.
So what's the first thought for most business owners? Okay, we need cash for a buyout. Let's just head to the bank. It seems like a pretty simple, logical solution to a cash flow crunch, doesn't it?
Well, here's the kicker. The really tough truth is that the very thing that's forcing you to get the loan, losing a key productive partner, is the exact same thing that makes your business look like a massive risk to a lender. You're basically walking into the bank saying, hey, one of our main engines just failed. Can we have a bunch of money? You know, banks aren't exactly big fans of betting on trouble.
So if a loan is a long shot, what's the answer? Is the business just doomed? No way. This is where planning ahead becomes a total game changer. There's actually a financial tool designed for this exact nightmare scenario, built to save a company from going under.
It's called buy-sell disability insurance. And honestly, the concept is pretty simple. It's an insurance policy that gives the remaining partners a big lump sum of cash for one reason and one reason only, to buy out the shares of the partner who's now disabled. You see the difference? This isn't a last-minute scramble for a loan. It's a plan, a funded solution just sitting there ready to go when you need it most.
So how does it actually play out? It's really just a few simple steps. 1, a partner becomes permanently and totally disabled. 2, a waiting period goes by. They call it an elimination period. It's usually about 12 months, just to be sure the disability is truly permanent. 3, boom, the policy pays out a big old lump sum benefit. And 4, that cash is used to execute the buy-sell agreement. It's clean, it's smooth, and it's all taken care of.
And when you look at it this way, you see two completely different paths a partnership can take. On one side, you have the unprepared business. They're in total financial distress, scrambling for loans they probably can't get, and the whole company is at risk of collapsing. But on the other side, the prepared business. For them, it's a seamless buyout. Financial stability is maintained, the partnership is protected, and the business just keeps on trucking. It is a night and day difference.
Okay, so that solution is pretty great, right? But what if I told you we could make it even better? Because that standard plan, as good as it is, has one little gap we haven't talked about yet. And there's a more advanced version that plugs that hole perfectly.
Let's think back to that 12-month waiting period. Yeah, the big buyout check is coming, but it's a year away. The business is hurting from day one. How is the company supposed to pay for a temp to cover the slack, or all the overtime the healthy partner is now working? Who covers all those extra costs that pop up immediately?
And that is where something called the Buy Sell Plus comes in. It's a really smart product that basically bundles two policies into one powerhouse policy, specifically designed to bridge that dangerous 12-month gap.
Check out how this timeline works. It's brilliant. First, there's a much shorter 90-day elimination period. After that, for the next 9 months, from month 4 to month 12, the first part of the policy kicks in. It starts paying a monthly benefit directly to the company. That's the key person coverage, helping you cover all those extra expenses. And then, right at the 12-month mark, the second part triggers, the huge lump sum for the buyout. It's a perfect two-stage solution.
So the plus advantage here is just massive. You're getting key person and buy-sell coverage all rolled into one. It takes a huge amount of financial stress off the company during that super critical first year. And the best part? Because you're bundling, you actually get a discount. So you're getting way better coverage for less money than you'd pay for 2 separate policies. It's a total win-win.
All right, to really get a handle on all this, you gotta know the lingo. So let's do a quick-fire round of a few key terms that you're absolutely gonna wanna know.
First up, elimination period. We've said it a bunch, it's just the official name for that waiting period, right? The time you have to wait after the disability starts before the insurance company starts cutting checks.
Next, we've got loss payee. Sounds fancy, but it just means who gets the money. It's the person, or more likely, the company itself that's officially designated to receive the benefits from the policy.
Okay, this next one is a really cool built-in feature. Waiver of premium. Basically, if you become disabled for more than 90 days, you stop paying for the policy. The premiums are waived for as long as you're disabled. It's a small detail, but man, it has a huge impact when you need it.
And last but not least, probably the most important definition of all, permanent total disability. Now, to trigger that big buyout payment, the disability has to be, well, permanent and total. It can't be temporary. A competent medical authority has to state that the person isn't expected to recover and come back to work. This makes sure the buyout is only used for those truly career-ending situations.
You know, there's a quote that just sums this all up perfectly. Proper planning is one of the keys to a successful business. And that's the thing, right? This isn't about being negative or pessimistic. It's about being a professional. True success isn't just about riding the wave when things are good. It's about building a business that's tough enough to handle the storm when things go bad.
So I'll leave you with this one final, really important question. It's not about if something unexpected could happen, it's about what your plan is for when it does. So take a hard look at your own partnership, at your agreements, and ask yourself honestly, is your business truly prepared for the unexpected?